Tim, do we need to kind of, forget the conversation about when inflation is coming and focus on whether the U.S. is overheating? Do we have an overheated economy? And if we do, then what does that mean for the markets?
So one of the other areas where we don't see a problem is the availability of finance remains reasonably strong. So if you want to borrow money in the States, you can. So I don't think it's overheating yet, or there are certain pockets of the country where there is virtually no unemployment. You've struggled to find workers, but for some reason it's not manifested into higher wages yet. So the risk we have is that the starting level of yields for bonds are too low. With the honourable exception possibly of the US, inflation is rising, interest rates are going up, quantitative easing becomes quantitative tapering, and arguably the bigger problems are here in Europe, where we've got negative yields as the starting point.
Tim, let me bring you over to my chart, and this is kind of a very simple 10-year yield. There we go back to some of the comments that Jeffrey Goodlack was telling us. We're about to speak to Ray Dalio, who I know will be asked about treasuries. When does it hit 3%, the 10-year yield, and what happens after that?
We're sort of boiling the frog, aren't we, really? We're sort of going up in yields gently, and it's not really affecting other markets dramatically. I've mentioned how the rand was one of the strongest currencies, and that was before Ramaphosa got elected. That is not what any person would have forecast based on previous correlations had you said there was going to be an equity shock of the size we had at the beginning of February. 3% shouldn't be too bad. We should be able to achieve 3% without upsetting other markets. 3.5, okay, now we're seeing a risk-free rate that is really quite comparable to dividend yields, and you know, where every treasury yields more than every Spanish bond, in the government space, more than European high yield. Why would you bother with those other asset classes if you can achieve 3.5 in treasuries? That's when the upset occurs.
Right, but this could turn, couldn't it?
Indeed.
And it could turn quickly.
Well, what is interesting is that I think it's already offering a reasonable sort of risk-free rate, which has not been on offer for several years now. And so, yes, we've been short duration for some time now, but we have covered that. We are now neutral on duration. I think we could have at least a pause in the bond sell-off.